So yes guys, we will talk about a very interesting standard, that is Ind AS 23. Ind AS 23 broadly deals with something called as borrowing cost. Now the first thing which I get in my mind when I talk about borrowing cost is the cost which is affiliated to a borrowing or incidental to borrowing, that is interest. However, the scope of the standard goes much beyond just an interest. And why are we even specifically talking about borrowing cost? Borrowing cost is also an expense. Why don't you charge off the expenditure to P&L? This is what the standard is talking about or prescribing, because there is a particular accounting treatment which Ind AS 23 has actually proposed for a particular kind of assets. Now let's see what borrowing cost is talking about. Borrowing cost, for a definition, says that it includes, number one, effective interest rate. We'll have to discuss about this. Also includes finance charges under finance lease, also includes exchange losses to the extent they can be regarded as borrowing cost. Now there's an in-depth understanding of each particular part of the standard definition. Let's see what it actually talks about. I'm starting with the first one. What is this effective interest rate? When I use this term effective interest rate, this effective interest rate, it encompasses or includes multiple items. Interest can include processing charges, also includes discount on issue of debentures or premium on redemption of debentures. This is what an effective interest rate actually includes. So when we talk about effective interest rate, we are trying to include the interest and the processing charges, also the amount of discount on issue and premium on redemption of your debentures and bonds. Both put together, I can put across and I will say that it is effective interest rate. How do I identify this effective interest rate? The identification is very simple. All we have to do is, this is an IRR calculation which is required. How do I apply this IRR? To apply this IRR, basically we are start looking at a different perspective. What we are trying to say is the incidental cash flows from borrowings if I discount it to present value, discounted to present value should be exactly equal to 0, then I will say that that is a rate of effective interest. Now we will understand with the help of an example. Just for park it aside, I will talk about the example later on. Then what is this finance charges? Let me get up to the next part, that is finance charges under finance lease. This finance charges under finance lease is basically dealt under a separate standard, Ind AS 17, which talks about leases. So I'm parking it aside, I'll talk about this. The last part, that is exchange differences or exchange losses, to the extent they can be regarded as borrowing cost, this has to be understood as in reference to Ind AS 21. So furthermore explanation is required under each case. We will have to understand how this effective interest has been identified. How do we talk about your exchange differences? But finance charges I will discuss only when I'm talking about finance leases under Ind AS 17. I'm parking this concept, but I'll deal with the first and the last part with the help of some examples. That is where you'll understand where we exactly get about and how do we identify these effective interest rates. Yes guys, so let's continue with understanding what is effective interest rate. Very important concept under Ind AS 23. Now this word effective interest rate has been defined or has been measured as per Ind AS 109. There are multiple places which uses the word effective interest rate, but all the standards refer only to the word effective interest rate, but this word effective interest rate has been defined and has been measured as per Ind AS 109. Now what does this effective interest rate actually talk about? Effective interest rate actually includes any processing charges which are incidental to the loan. What are the processing charges? Normally when I apply 100 rupees of a loan, 100 rupees does not get credited into my bank account. What you get a credit is 100 rupees and immediately there is a 2 rupees of a debit saying that it is bank charges. These are called as processing charges. What are those processing charges actually? Because when I have to register a mortgage of the property which I have given as a collateral, such property mortgage always has something called as registration of charges. You have to pay MCA fees. You have to pay stamp duty on that. All such incidental charges put together, the bank charges one consolidated amount called as processing charges. Along with that, chartered accountant facilitates the person who wants to seek a loan to make sure that the documentation is proper for whatever is being submitted to the bank. Now we are not going to do any charity out there. We'll also be getting some amount of remuneration from the customer for processing the loan. All such amounts can be called as processing charges. They are incidental to the borrowing. Sometimes you can have discount on issue or premium on redemption of debentures and bonds. Premium on redemption on debentures and bonds. Debentures and bonds are also long-term sources of finance, so even they will be considered as a borrowing, and all those discounts on issue or premium on redemption, if any, will also be considered as an amount which is incidental, will also be included under the computation of effective interest rate. What exactly is the effective interest rate and how do I calculate that? Like I said, EIR is simply equal to the IRR, where the present value of cash flows arising from borrowing are equated to 0. This is the place where we get the actual effective interest rate. For example, let's take an illustrative understanding of this. Let's say, for example, I have a loan, and let's say this bank loan was about ₹1,00,000, and this, let's say, had to be paid in 5 equal installments along with interest. Such interest is charged at the rate of, let's say, 10% per annum. When I have a situation like this, let me give you the understanding of it. Let's say the processing charges of this case, certain processing charges I will deduct, and I'll say that, let's say the processing charges were about 4,000. Now look at the cash flows now. The cash flows being generated can be given like this: year 0, 1, 2, 3, 4, 5. Now during these years, if I understand the cash flows, should go something like this. First, I got a positive cash inflow of 96,000. How did I get 96? I have applied for a 1 lakh rupee loan. Either 4,000 rupees of processing charges got deducted. My net cash flow is only 96,000. Now think about the first year. First year, I'm supposed to calculate the interest on this particular 1 lakh. 1 lakh at the rate of 10%, not 96,000. I'll charge the interest on the principal amount, that is 1 lakh. 1 lakh into 10% is 10,000. You're paying in 5 equal installments. That means each installment itself is 20,000 for principal. So I'm paying 20,000 towards principal, compulsory every year. Along with that, I'm also paying the amount of interest. In the first case is about 10,000. So I'm having a negative cash flow of 30,000 in the first year. Now my loan outstanding at the end of first year has come down to 80,000 because I have done 20,000 of principal repayment. That 80,000, I'll again charge 10% interest for the second year, which becomes 8,000. Principal repayment is constant 20,000, so my cash outflow becomes 28. Like this, it becomes 26 in third year, it becomes 24 in fourth year, and finally 22 in fifth year. I'll have to make sure that I apply some discount factors, add up whatever percentage it is for n number of years, and I have to multiply and I'll get the discounted cash flows. All you have to do is make sure that your discounted cash flows are zero at a particular rate, and this rate which I've applied here is called as a IRR, or in our case we are calling it as effective interest rate. Understand, though the interest is 10%, by solving the equation like this, the percentage that you're gonna get, your EIR, is definitely being more than 10%. In this case, I think you will land up to about 10.7 or percent of whatever it is, 10 to 11% in between you will be landing out. Now that is because of the processing charges which were included. Had I taken 1 lakh here and discounted the cash flows, I would have got exactly 1 lakh. Now this is how we are trying to understand what an effective interest rate is. Now this effective interest rate has to be incorporated as far as your Ind AS 23 is concerned, because it is not the 10% which we're going to consider as borrowing cost. We are considering 10.7 as the borrowing cost. Now by considering 10.7, what we are trying to do is, this 4,000 rupees which were charged initially as processing charges, I am not considering it as an expense in 1 year itself. We are considering it as an expense over the period of the borrowing being repaid. So this is the primary understanding of why we actually apply this rate called as effective interest rate. Got it? Had this effective interest rate concept not been there, then this processing charges would have been amortized to P&L or sometimes directly charged to P&L. So to harmonize the effect or charge to P&L, we are trying to identify something called as effective interest rate. Clear? So yes guys, let's see what this exchange differences have to do with Ind AS 23. Exchange differences actually dealt as per Ind AS 23 to an extent. They can be regarded as borrowing cost. What is this concept all about, and why am I treating an exchange difference which is as per Ind AS 23 as borrowing cost as per Ind AS 20 exchange differences as per Ind AS 21? Why am I treating it as per borrowing cost as per Ind AS 23? There should be some logic in understanding why is this actually happening. Let me explain with the help of an example. Let's say, for suppose, I required a borrowing of, let's say in rupee, I want a borrowing of about 5 lakhs. This is the borrowing which is required. I started assessing it and I understood that the interest rate in India was about 10% per annum, let's say. Well, I started assessing what could be the rate if I would have borrowed in dollars. Then I said I can't borrow $50,000 I have to apply exchange rate. Let's say for the purpose of ease, let's say dollar rate was 50. How many dollars you should have borrowed? To make it 5 lakhs, I need to borrow $10,000. If I borrow $10,000, I'll convert it at 50 rupees per dollar. I'll get back to my 5 lakhs. Had I borrowed in dollars, I would have actually got the borrowing only at, let's say, 5%. Now understand, think from a businessman's perspective. Why should I pay 10,000 rupees per annum, 10% per annum, when I can actually get the borrowing at 5% per annum? He started assessing the interest impact. Interest at the end of year, if I calculate, here I was supposed to pay about 50,000 rupees. Well, here I was supposed to pay only $500. Let's say exchange rate at the end of the year was about 55. What I'll do, I have to pay $500 at 55 rupees. Considering this, my rupee equivalent amount will be 27,500. I would still say it is beneficial, though the dollar rate has increased, because had I borrowed in rupee, I would have paid 50,000. Now I am paying only 27,000. Comparing these two terms, I can identify that there is a savings in interest. My savings in interest is about 22,500. Now let's understand what is happening here. This situation, what has come up right now, we'll have to assess it with respect to Ind AS 21, that is exchange differences. According to Ind AS 21, the dollar borrowing is a monetary item. So you have to compulsory restate monetary items at closing rate, and this is given as per Ind AS 21 exchange differences. So I am supposed to restate the monetary items at closing rate using Ind AS 21, with which I am understanding that there is an increase in the dollar. Dollar rate increase, what will you repay? I am not supposed to repay in rupee. I am supposed to repay dollar. How many dollars you will repay? $10,000 I have to repay. But for me to repay $10,000, today I have to buy each dollar at 55 rupees. But when I actually bought the loan, or when I took the borrowing, it was only 50. So that earlier I would have recorded the borrowing as 5 lakhs, but now I am saying I have to repay $10,000 buying each dollar at 55 rupees. That means I have to spend 5,50,000 rupees to basically repay the borrowing. Borrowing has increased in value as far as your rupee terms is concerned. Though in dollar terms it is 10,000, in rupee terms it has increased from 5 lakh to 5,50,000. Reason being your exchange rate. These are called as exchange losses. Exchange loss on FC means foreign currency. On foreign currency borrowing should be calculated this way. $10,000 into 55 minus 50 rupees per dollar, you would be getting about 50,000 rupees. What we are trying to say here is, this 50,000 rupees is an exchange loss as per Ind AS 21, which should be treated as per that respective standard. But I am trying to say that out of this 50,000 exchange differences, to an extent they can be regarded as borrowing cost. What is this extent? Now let's see what he's saying. Borrowing cost is lower of number 1, savings in interest, or exchange loss on foreign currency borrowing. Look at the amount now. Savings in interest is 22,500, while exchange loss on foreign currency borrowing is 50,000 rupees, which is lower out here. 22,500 is lower. This should be treated as borrowing cost. So what we are saying, out of the exchange loss that we have suffered, we are saying that I'll split this into two types. To an extent of 22,500 rupees, this should be treated as borrowing cost under Ind AS 23. While to an extent of the balance amount, that is 27,500, I will treat it as exchange loss as per Ind AS 21. This is what we understand as far as exchange losses are concerned. To an extent, they can be regarded as borrowing cost. So in this case, what we are trying to say is the exchange loss on borrowing to an extent can be regarded as borrowing cost. To what extent? To the extent of lower of the savings and interest or the entire amount of exchange loss. If your savings and interest is lower, then a portion of the balance portion should be treated as per Ind AS 21. Ind AS 23 is not talking about that. This is a practical understanding of how the situation actually appears. Now understand, whatever he has done is absolutely logical. Think about it. I have borrowed in dollars just because the interest rate was lower. Understand, by making a borrowing in dollars, I have assumed some risk. What risk? The currency risk. The exchange rate risk is what I have already assumed. Such exchange rate risk during the year has resulted in a loss of 50,000. Now, why did you take that exchange risk? You should have actually borrowed it in dollars. Then he's saying, sir, I took that exchange risk because I was getting a savings as far as interest cost is concerned. Since I was trying to save the interest cost and then I have taken the exchange rate risk, the exchange rate risk has resulted in a loss. Why did you incur that loss? Because I wanted to reduce my interest. How much interest did you reduce? I reduced only 22,500 interest. How much did you incur as exchange loss? 50,000. So he's saying, to the extent of the 22,500 which you avoided by borrowing in dollars instead of borrowing in rupee, to that extent I will still treat it as borrowing cost. The balance amount, I am not going to talk about that. Let Ind AS 21 deal with that. Clear? This is the underlying concept and the logical treatment which is supposed to be given as per Ind AS 23. That is borrowing cost. Clear? Now we have to understand what will happen if subsequently there is an exchange gain. Now here 50 to 55, there is an increase in dollar. There could always be an amount of decrease in the dollar rate at some years. Initially there was a loss, no problem. You have treated it as borrowing cost. But sometimes, let's say for suppose in the subsequent year the dollar has come down to 53, then there is a 2 rupees of saving. Then to that extent of 2 rupees, what are we supposed to do? Let us see what we'll do with that. So yes guys, let's try to understand what if there is a subsequent exchange gain on foreign currency borrowing. If there is a subsequent exchange gain on foreign currency borrowing, then we say that to an extent it was treated as borrowing cost should be dealt as per Ind AS 23. That means to an extent of this 22,500 which you earlier recognized as borrowing cost, to that extent I will treat it as per Ind AS 23. The balance exchange gain will be treated as per Ind AS 21. Let's see what we're trying to talk about here and what does this even mean. First, suppose, for example, let's say the dollar in the subsequent year the exchange rate has come down to about 53 rupees per dollar. I earlier recognized at 55, now I'm recognizing at 53. So what is happening? I have saved, or I have actually got a gain of 2 rupees per dollar. My liability, which was 5,50,000 last time, has now come down to only 5,30,000, giving me a 20,000 rupees of gain. So my exchange gain will be 20,000. How much did you earlier treat as borrowing cost? 22,500. How much did you get exchange gain now? 20,000. To an extent it was treated as per Ind AS 23. It will continue to be treated as per Ind AS 23. So here the entire amount should be dealt only as per Ind AS 23 because it has not exceeded this amount 22,500. That is why we are saying that though it is an exchange gain, I will still continue to treat it as per Ind AS 23 itself. However, if the exchange rate falls even further to 52 rupees per dollar, then in such case, identify the exchange gain then. Exchange gain this time will be 30,000, saving of 3 rupees per dollar. Out of this 30,000, how much was earlier treated as per Ind AS 23? 22,500. So rupee 22,500 will be treated as per Ind AS 23. There is still a balance left out. How much? 7,500 rupees of gain. This will be treated as per Ind AS 21. This is regarding the subsequent exchange gain which will be recognized on foreign currency borrowing. So what are we trying to say? To an extent, you have treated the exchange loss as borrowing cost under Ind AS 21. To such extent, if there is a subsequent exchange gain which is recognized, I will treat it as per Ind AS 23 itself. After that, any balance, if any, I will treat it as per Ind AS 21 as exchange gain. So this is what we understand as per the exchange losses. To an extent, they can be regarded as borrowing cost. Yes guys, so the primary thing which Ind AS 23 will talk about is the treatment of borrowing cost or the recognition of borrowing cost. Till now what we have discussed, either as per effective interest rate or exchange rates or exchange losses to the extent they can be regarded as borrowing cost, was entirely the ambit of definition of borrowing cost. We still haven't seen what is the accounting treatment or what is the recognition of borrowing cost, and that is the crux of the entire standard Ind AS 23 talking about. What does Ind AS 23 deal with? Ind AS 23 says the borrowing cost on a qualifying asset is eligible to be capitalized. While other borrowing cost should be simply charged to P&L. This is what the standard actually prescribes. Understand the terms which are being used out here. We are saying the amount to which it extends, which pertains. Yes guys, so every standard has a particular purpose. When I said Ind AS 23 talks about borrowing cost should have an inbuilt purpose. Now what is the purpose for which Ind AS 23 has been issued? When we are talking about borrowing cost is a simple expenditure, and such expenditure normally being charged off to P&L. then why do I need a separate standard to discuss about it? Simply charge it off to P&L, that is it. Close the issue. But that is not exactly what Ind AS 23 is talking about. What Ind AS 23 talks about is about the recognition of such borrowing cost. My recognition of borrowing cost has been mentioned under Ind AS 23 specifically, and there is a peculiar treatment that he has prescribed under the standard. What is the peculiar treatment? He says such recognition of borrowing cost should be split into two parts. There are two types. Borrowing cost incurred on qualifying asset. We will discuss what this qualifying asset is, and other borrowing costs. Borrowing cost incurred on a qualifying asset is eligible to be capitalized. While the other borrowing cost, any other borrowing cost, is charged to P&L. Now this is what we can talk about recognition of borrowing cost. I'm saying a borrowing cost, if it pertains to an asset called as qualifying asset out here, we are supposed to capitalize such cost, and if it is any other treatment, then we will have to charge it off to P&L. So capitalization and P&L. P&L is a regular treatment. I don't have to even discuss further if the amount is being charged to P&L. But since I'm capitalizing it, I'll have to discuss further about what this qualifying asset is, what is the amount that is eligible to be qualified, when to capitalize and when not to capitalize. All these concepts have to be discussed in depth. Let's start with understanding what a qualifying asset is. Qualifying asset. To define this qualifying asset, we simply say that this is an asset which necessarily takes a substantial period of time to get ready for its intended use or sale. There are certain things which we have to understand very carefully in the standard. The definition is talking about an asset which necessarily takes substantial period. What is this substantial period? Question number one. Asset ready for its intended use or intended sale. What type of assets am I talking about here? When I say an asset is held for use, that means I'm talking about property, plant and equipment, or even the intangible assets. Use. When I'm saying sale, I'm referring to something called as inventory. Now if we look at inventory per se, I'm saying that an asset can be an inventory which qualifies for the definition of qualifying asset, and then if it satisfies the definition of qualifying asset, you are saying that the borrowing cost is eligible to be capitalized. However, there's a conflict which arises between Ind AS 2 and Ind AS 23. What is the conflict that we are referring to here? The conflict that we are referring to here is with respect to the borrowing cost. Ind AS 2 has specifically excludes interest and other finance charges, while including the word sale Ind AS 23 on the other hand says that if the inventory satisfies definition of qualifying asset, borrowing cost should be capitalized or is eligible to be capitalized. Two very conflicting views coming up here, guys. I'm discussing about two conflicting views between the standards, where one such standard is talking about excluding the interest and finance charges, while the other one is asking me to capitalize the amount of borrowing cost if the definition of qualifying asset is satisfied. Now, you can't comply with both the standards in a given situation, because one standard is saying the cost should not include it, the other standard is saying that it has to be capitalized. Now, since I cannot comply with the standard, there should always be a stand saying that one standard prevails over the other. Now, which standard should be prevailing over the other? That question comes up. I will say that this is a general standard. This is a general standard because it applies to all inventory. But this I'm talking about is a specific standard. Why is it specific? I'm not talking about every type of inventory. I'm talking about only such inventory which satisfies the definition of qualifying asset. If it satisfies the definition of qualifying asset, then I will call it as then I will make sure that I'm complying with Ind AS 23. Therefore, I can say that Ind AS 23 prevails over AS2. Or Ind AS2. This is what we can derive from the conflicting paragraphs of each such standard. Now, this is regarding use or sale. We have to understand something called as substantial period of time. Very important word, guys. Substantial period. What does this word substantial period even stand for, and how is it significant in explaining what is a qualifying asset? Now, let's see. When I say substantial, what do you understand in a general knowledge? General sense, substantial period means much longer than a normal period. Now, this much longer than a normal period is very dangerous because it allows enough scope of interpreting in multiple ways. For example, let's say, very relatable example I'll take. For a student who is actually pursuing the course of chartered accountancy, 6 months is a substantial period. For me, the life changes every 6 months. The people around me change every 6 months. The circumstances around me change every 6 months. But for an engineering student of the same age, such particular person, we normally say that 4 years is a substantial period. Because during the 4 years period, whenever he wants to clear the course, he can clear the course, ultimately he'll get the certificate. So that means two different courses, two different professional courses which are being pursued by two people of the same age allows for different type of evaluation or interpretation for this word substantial period. So enough scope is there, or enough subjective definition can be given as far as the substantial period is concerned. So we'll have to come up and give a much more consolidated definition saying that this exactly is what I mean by substantial period. If I leave enough scope for people to start interpreting it, unfortunate thing is each one will have their own set of standards. But understand, accounting standards per se have been given to make sure that people are following uniform set of standards. Why do you need uniform set of standards? So that you have financial statements on comparable basis. But if I allow such interpretations to happen in multiple ways, then the comparability is normally questioned. That is the reason why we'll have to figure out something to be fixed for the substantial period. Substantial period, I would start by saying that it is not explained in India is 23. Doesn't mean I leave it like that. I will give an appropriate explanation for that. But however, even the preceding standard, if I talk about, that is AS16, the previous generation standards of IGAP, AS16 corresponding standard is India is 23, that is borrowing cost. We did not have an explanation for substantial period. However, then came in the concept of accounting standard interpretation 1. This accounting standard interpretation 1 at that point of time said that substantial period should be a period which is greater than 12 months. Accounting standard interpretation said that it is a period which is exceeding 12 months. It can be considered as substantial period. However, he said that this term is a rebuttable assumption. What do you mean by this term, rebuttable assumption? Now this term rebuttable assumption has been used multiple times in the standard, so we'll have to understand what this rebuttable assumption actually stands for. When I use the word rebuttable assumption, what I meant by saying is a period shorter than 12 months can also be considered as substantial period if sufficient facts of case are provided. Understand what he's saying now. He's saying that it is a rebuttable assumption. By the word rebuttable assumption, what we understand is that you can contradict the assumption. I can make sure that I'm using a period which is much shorter than 12 months also as substantial period. But for me to take such stand, I'll have to provide sufficient facts of the case. So rebuttable assumption means there are assumptions taken by the standard by and large which can apply to most of the cases. But however, if I have sufficient facts of the case which can make me believe that a period much shorter than 12 months can be considered a substantial period, I would consider such period as substantial period instead of taking this period of 12 months. Instead of taking this 12 months, I can take much shorter period. This is what we can understand by this word substantial period. So I'm saying an asset which necessarily takes substantial period to get ready for its use or sale will be called as a qualifying asset. And if I have a qualifying asset, then the borrowing cost attributed to that is eligible to be capitalized. This is the crux of the standard. If someone will ask me what was AS23 talking about, I will say that it talks about capitalization of borrowing cost on qualifying asset. In essence, this is what we talk about. We are saying Ind AS 23 talks about capitalization of borrowing cost on a qualifying asset. So this is what a qualifying asset is, how we define it. Now we'll have to look at how to capitalize, how much amount to capitalize, how to quantify it. Now all such things we have to start looking at, but this is the understanding of the basic core concept of what the standard is. So like we have seen, the essence of the standard is basically to help us understand what is the concept of qualifying asset. And the Ind AS 23 always emphasizes on capitalization of borrowing cost on qualifying asset. Now we have identified what is a qualifying asset. Now what we understand is how to measure the amount to be capitalized. When I say borrowing cost is eligible to be capitalized, then how much? What is it which is eligible to be capitalized? Borrowing cost eligible to be capitalized. What is the amount of borrowing cost which is eligible to be capitalized? When I talk about borrowing cost eligible to be capitalized, the first thing that will enter into my head is, first thing, how many types of borrowings are there? Whether I have a specific treatment for each kind of borrowing. Yes, we have. Whenever we are talking about borrowing cost eligible to be capitalized, the first thing that you have to understand that my borrowings for this purpose are split into two types. One is called a specific borrowing. Other one is known as non-specific, or you can call them as general borrowing. What does each one stand for, or how do I define what is specific and what is non-specific? Specific borrowing, what do you understand by that? The first look of it will explain you that this borrowing is specifically taken for the qualifying asset. As simple as that. This borrowing is taken for this qualifying asset. But unfortunately, the standard does not give such easy definitions. They'll always make sure that you are turning around the situations and they're trying to produce a definition which will confuse all the rest except the chartered accountants. But that's why we came out with a very interesting definition. What we say is, I would have avoided this borrowing had I not taken the construction of that qualifying asset. I would have avoided this borrowing had I not taken the construction of that qualifying asset. Ultimately, what are you trying to say? You're trying to say that that borrowing was taken only for that particular purpose and nothing else. So that is what specific borrowing is all about. When I talk about specific borrowing, what we indicate here is a borrowing which would have been avoided if the construction of qualifying asset was not taken up. While non-specific borrowing, so lengthy definition is not given. In simple terms, he says it is other than specific borrowing, that's it. Now we have to understand, we have only classified the borrowings as specific and non-specific. We did not talk about what is a borrowing cost eligible to be capitalized. That was our heading. What are we saying? There are two types of borrowing. If I have one qualifying asset, let's say building. This building has to be constructed. It is a qualifying asset because it took substantial period of time. That means the period is beyond 12 months. Then in such case, for the construction of that building, I have gone to IDBI bank, acquired a loan, and that loan has been utilized only for the purpose of that construction. However, the enterprise already had an existing borrowing which to an extent have been used for other purpose and to an extent has also been used on the qualifying asset. So that IDBI loan will be called as specific borrowing. The loan which was already existing is called as non-specific borrowing. How do I identify the borrowing cost eligible to be capitalized? This is what we are talking about. Borrowing cost eligible to be capitalized is equal to the actual borrowing cost on specific borrowings reduced by less return on idle funds. Actual borrowing cost reduced by the amount of return on idle funds. This is the amount of borrowing cost which is eligible to be capitalized. Understand, guys? Idle funds means, let's say for example, If I have acquired a borrowing of 100 crores from IDBI Bank today for the construction of a particular building, which is a qualifying asset per se, the entire 100 crores is not consumed on one single day. I will consume that 100 crores over the period of time. But the bank has disbursed the money at one stretch. Since it is a specific borrowing, I cannot use it for any other purpose except for the construction of the qualifying asset. So what I have to do? I need only 20 crores of fund for at least the first 3 months. I don't need the entire 100 crores. What do? The balance 80 crores, we start investing elsewhere so that we make some return out of that idle fund. Such amount of return that you have made out of idle fund has to be deducted from the amount of borrowing cost, and only the residual amount is eligible to be capitalized. That means, let's say, for example, I add 100 crores of borrowing, it carries 12% rate of interest. Now that 100 crores of borrowing, 12% rate of interest during the entire year came out to about 12 crores, out of which 80 crores were idle fund throughout the year. Such 80 crores I invested elsewhere at 8% return. How much amount of interest did I gain? I got a return of 6.4 crores. On that 80 crores, I got a return of 6.4 crores. How much did I pay? 12. How much did I get a return? 6.4. How much is it eligible to be capitalized? The difference, that is 5.6. 12 minus 6.4. That is what he's talking about in specific borrowing. But when we are talking about non-specific borrowing, we have to understand that borrowing cost eligible to be capitalized can be given as borrowing utilized. You did not take the entire borrowing only for this purpose, so utilization of the borrowing should be considered, multiplied by something called as capitalization rate. Multiplied by something called as capitalization rate. Then what exactly is this capitalization rate? Amount of borrowing utilized. Let's say the non-specific borrowing was 100 crores. I've used it for plenty of purposes, including the purpose for the construction of a building, which was a qualifying asset. I invested only 25 crores out of the non-specific borrowing in that. How can I apply this formula, actual borrowing cost? Because the actual borrowing cost was the entire borrowing. Only to the extent I have utilized, I have to capitalize. So that's why only to the extent you have utilized, multiplied by capitalization rate. What exactly is this capitalization rate? Capitalization rate is nothing but a weighted average rate on borrowings or non-specific borrowing a weighted average rate on non-specific borrowing can be considered as capitalization rate. What is this weighted average rate? How do I identify the formula of this weighted average? The formula can be given like this. Capitalization rate is equal to total borrowing cost on non-specific borrowing or general borrowing, you can name it, divided by total non-specific borrowings. This is the formula for my capitalization rate to be applied. Remember guys, this formula will hold good only if an enterprise has multiple non-specific borrowing. If the enterprise has only one non-specific borrowing, what is weighted average rate then? Weighted average rate will be the rate of that particular borrowing. Here I am only talking about, multiplied by 100 because I am talking about rate. Yeah, so here I am talking about The case where if I have multiple kinds of borrowing cost or multiple non-specific borrowing, how will I identify the capitalization rate or weighted average rate can be indicated this way. Got it? So this will conclude the concept of borrowing cost which is eligible to be capitalized. We have divided them into specific and non-specific borrowing, and each such borrowing has a different way of recognition or a different way of measuring the amount of borrowing cost eligible to be capitalized. Now, we will discuss about another small concept out here where we say that borrowing cost should not be capitalized. I'm talking about exceptions now. If I will not capitalize the borrowing cost if asset is initially recognized at fair value. Asset is initially recognized at its fair value. Guys, initially recognized at fair value. If you capitalize the borrowing cost, what will happen? The cost of the asset will be fair value plus borrowing cost. That means you are inflating the asset beyond its fair value, which is not possible. So we will have to ensure that I'm restricting it to the fair value. So asset should be only if it is initially recognized at fair value, then further capitalization of borrowing cost should not apply. Number one. Number two, for inventory manufactured on repeated basis, you cannot apply this standard. I'll tell you why I did not apply the standard there. If the inventory is measured on repeated basis, the word which is being used out here, now small quantities, multiple types. So what is happening? You cannot identify what is substantial period of time, because if someone will ask you, let's say I have given an order for 10,000 units per day, it is possible for an enterprise to only produce 25 units. Then what will happen? To get 10,000 units out, then the manufacturing entity has to spend 10,000 divided by 24, that is almost 400 days. 400 days is beyond one accounting period, then you will say it is substantial period of time, which is not so, because it is an inventory which is manufactured on a repeated basis and it's a large quantity. That's why it might look like a substantial period, but it is not so. Very, very interesting concept, guys, because it will always lead to a misconception that if I get a big order, then it will become a substantial period of time, which is absolutely wrong. You will have to understand that if you are doing an inventory manufacture, such inventory, if it is done on a repeated basis, just because the quantity is large and it takes a substantial period of time, you cannot construe it as a substantial period. You cannot continue to capitalize the borrowing cost. You cannot conclude that those inventories will classify or will satisfy the definition of qualifying asset. This is what we are talking about. Two exception rules which we can talk about. I will name this, if you want, I'll name this as exceptions to capitalization of borrowing cost. These are exceptions for capitalization of borrowing cost. Now this is what we can talk about and nothing else in the standard. As far as this part is concerned, we have other concepts of the standard as well, which we'll have to discuss. That is when to start and when to stop capitalization. We have to start and stop capitalization at a particular periods, and what is those conditions to be satisfied to start or stop capitalization process. Let us understand that. Yes, guys, in substance, we have to discuss about three concepts now. The first one being commencement of capitalization. I mean to say, when should I start capitalization process? when should I start this process of capitalizing the cost? Capitalization of borrowing cost should commence at a particular point of time. Let's say, for suppose, if the construction of a qualifying asset commenced on 1st April, initially I have invested my own money into the project. However, I have taken the borrowing on 1st of October. So what happens? I started incurring borrowing cost only after 1st October, but the qualifying asset started on 1st of April. The period between 1st April to 1st October, am I eligible to capitalize the borrowing cost? Answer is no. Reason? There is no borrowing cost at all. There was a qualifying asset, but where is the borrowing cost for you to capitalize? You have taken only the borrowing on 1st of October, so your capitalization can only commence on 1st of October itself. Number 2, I've taken the borrowing on 1st April, but the process of constructing a qualifying asset only commenced on 1st July. 3 months was a period for which I did not take up any process of construction. So what is happening now? For that 3 months period, did I incur the your borrowing cost on that particular borrowing? Yes, I did. I have to continue to pay interest. I cannot go and tell the banker, boss, I did not start the construction, so I will not pay the borrowing cost. That is not possible. The banker will say, whether you have commenced the project or not, whether you have utilized the fund or not, I have given you the money, you have to pay the interest, that's it. So this period of 3 months from 1st April to 1st July, I've incurred a borrowing cost, but the qualifying asset started construction only on 1st July. Is it eligible to be capitalized the first 3 months? Absolutely no. Because though you have incurred the borrowing cost on that particular borrowing, you did not start the commencement of qualifying asset. Without having a qualifying asset, where will I capitalize the amount of borrowing cost? So this way we have to understand that both of them together exist. So we have to say that commencement of borrowing cost should be started only when all the following conditions are being satisfied. When the following conditions are satisfied. What are the conditions which I am talking about? Number 1, capitalization should commence when the borrowing cost is incurred. Number 2, expenditure on qualifying asset is incurred. Number 3, activities necessary for construction of qualifying asset are in progress. These are the 3 conditions which are necessary to be satisfied for me to commence the capitalization process. Now, what are these activities necessary? Activities necessary for construction of qualifying asset are in progress. I paid advance to a supplier. Just because you paid advance doesn't mean that the qualifying asset has commenced. Supplier has supplied the goods to me. Doesn't mean that the qualifying asset is already in progress. Such goods are applied in the construction process. Yes, that is the date when I can say that the activity on the qualifying asset is in progress, and that is when you can start commencing the capitalization process. All the 3 conditions are being separated by the word and, so it necessarily requires all the 3 conditions to be satisfied for me to commence the capitalization on a qualifying asset. Now, when I say activities, it can include designing, planning, staffing, etc. where the activity is not physically visible. It is not physically visible for you to do the process, but it is still an integral part of constructing a qualifying asset. So we can say that compulsory you have to commence capitalization even though it is under designing, planning, staffing or any other phase at the initial operation. The second thing which I'm start looking at now, this will be an interesting concept. The second one which I want to talk about is called as cessation. What does cessation mean? Cessation, cease means stop. Oh, when to stop capitalization? When to stop capitalization has been interestingly given like this. Said the construction of the capitalization of borrowing cost on a qualifying asset should cease when the asset is ready for its intended use or sale. I'm saying you stop capitalization once the qualifying asset is ready for its intended use or sale. What basically happens in this case? Let's say I've constructed a building. This building was with an intention to lease it out to someone else. Majority of the building is substantially completed, but I did not find a person who can take it on lease. I'm still eagerly waiting for a customer. If I stop capitalization now, then what happens? The borrowing cost will start hitting my P&L now. It keep on charging to P&L. If it kept on charging to P&L, ultimately my profits will not be visible. It will completely go into losses because I do not have a lease income at all. So if I have a customer, I don't mind charging the borrowing cost to P&L. So what very cleverly this person has done, this enterprise has done is, they made sure that they did not complete the process. Every day they came, every day they would fit one window, they go back. Every day they fit one door, they go back. They're not intending to complete the work. They're trying to prolong the work as much as possible because I'm already incurring borrowing cost. Anyways, I don't have to do anything. The construction cost is already done. I don't have to do anything. If I complete the process, then you will say that the borrowing cost should cease to capitalize. Then the entire amount should be charged to P&L. I kept on doing like that for a month or two. Then I found a customer. Rest of the entire doors and windows were fit within a week time and it was handed over and I said I'm stopping capitalization. This means I'm trying to make undue advantage of wordings used in the standard. Now it's a ICAI which has drafted it, so it will leave a very little scope for anything as such. So let's understand what it says. Cessation means capitalization of borrowing cost should cease when the qualifying asset is substantially ready. Observe the words being used. For its intended use or sale. He did not use the word ready, instead he used the word substantially ready. Substantially ready means it is not complete. So that means I'm saying you need not complete it. If it is completed in majority of the content, that will be the seizure of your capitalization. You cannot continue capitalization of borrowing cost at all. This is what we talk about in cessation, when you have to stop. But an interesting concept has to be discussed here, that is suspension. What is suspension and what is the difference in cessation? Suspension means temporarily I'm stopping it. Cessation means permanent stoppage. I will not continue to use it by any chance again. So suspension and cessation are slightly different. Suspension is temporary break. Suspension is complete stop. So when we talk about suspension, why does the suspension actually happen? We are saying that capitalization should be suspended if active development of qualifying asset is interrupted for an extended period of time. I'll have two things to emphasize on. Active development. Second one, extended period of time. Let's understand this. Extended period of time. Let's say for suppose I did not use this word. I just said capitalization of borrowing cost should be suspended when active development of a qualifying asset is interrupted. If I would have stopped there, let's say this enterprise is a 5-day week. So Saturday and Sunday it is off. There is no construction on qualifying asset which is going on. 52 weeks, 2 days per week, 104 days. Gandhi Jayanti, Independence Day, that Jayanti, this Jayanti, ultimately put together another 20 to 30 days. So about 120 days out of 365 days, I haven't done any active development of the asset. So that means to the extent of this 120 days, the amount of borrowing cost should be charged to P&L had this words not been used. What am I using here? Beyond a normal period, extended period of time. Extended period means beyond normal period. If the period for which you have your active development is interrupted is for an extended period that is beyond normal, and normally occurs in the case of extraordinary situations. It's a not regular situation like a weekend coming up or Dasara holidays or Sankranti holidays or Pongal holidays which come up. We are saying that it should be extraordinary situation. It is beyond a normal situation. Then in such case only I will suspend. There is a strike. There is a lockout. The enterprise is out of funds. The management is in a turmoil. They are not able to continue the process for a temporary period. Such cases, I will put it under suspension of capitalization. And remember, the period for which the interruption happens should be an extended period, which means it is much more than a normal interruption which could happen. Active development. The reason why I highlighted the word active development is because very interesting situation actually arises here. Sometimes there are certain assets where it is necessary to be interrupted. It is necessary to stop the process for a period of time and start commencing all over again. Like a farmer, normally after each crop, he just plows the land and just leaves it like that because the fertility of the land or the solidity of the land normally gets frizzled out after each crop. So I have to leave it for a particular period of time. If I don't do that, my next crop is going to get affected. That is what I'm saying. So my interruption was very much necessary in completing the qualifying asset. Had that interruption not been there, the qualifying asset wouldn't have been complete. Even the constructions of buildings also, for a temporary period, you can't keep constructing each every day. You construct, you stop it, you start doing a process called as curing. Curing means water is being poured on all these walls and everything so that they solidify, and then you again start commencing your construction. So such period of interruption in active development is necessary. Without that, I cannot complete the asset. In such cases, even though there is an interruption, you can continue to capitalize because it was necessary for the construction of capitalization. For the construction of qualifying asset, it was necessary to do that interruption. So such interruptions will not amount to suspension. You will continue to capitalize the borrowing cost even during such interrupted period if such an interruption is necessary for the construction of qualifying asset. This, in a broad sense, is what Ind AS 23 is talking about regarding your capitalization of borrowing cost on qualifying assets.